Barry, you mentioned in the previous segment that there are so many data points that counter what the strong U.S. jobs market is telling us. Can we talk a little bit about what you're seeing that leads you to conclude, I think, that the economy is on tepid grounds?
Yeah, well, I think first of all, the most obvious one is the yield curve. I mean, it's been inverted 2s10s for over a year now. That's never happened without a recession. The global PMIs are all in contractionary area around the world, and it's not just the US, it's Europe and China, and that's never happened without going into recession. And, there's a longer list of things historically that lead us to believe that the economy should be slowing more rapidly than it is. Obviously, the employment part of this is strong, and if people have a job, they're generally spending. But if you look at consumer data, consumer bankruptcies are rising significantly. They're triple what they were a year ago. Credit card
There,
spending is going through the roof because savings aren't there anymore.
but
And
Barry, but the one thing though is I looked at this data the other day as well that the bankruptcies are triple, but they're apparently still at a very low level versus historical norms, correct?
they're not at a very low level, but they're not above average. So they've gone from extraordinarily low back to average.
Okay.
But I think you have to look at those things in the trend because, things generally don't go from really low to average and stop. Usually there's some overshoot there, but
Mm-hmm.
there is a lot of data that suggests that the economy should be much weaker than they are. Um, and there's biases to the data, and there's seasonal adjustments, and pandemic affected all those. So my gut instinct tells me that those trends are intact. It's just the timing is much more uncertainty because of COVID and the pandemic.
Mm-hmm. The negative trends are intact. We just don't know when we'll see more of a downturn because of the
Yeah,
impact of COVID and the amount of spending that's been in place.
yeah. And inflation is coming down, maybe not as quickly as a lot of people think, but you're going to see headline year over year inflation come down a lot in the next couple of months because there the monthly data a year ago for the next 2 months are 1.2 and 1.0, and the monthly data now is zero point 0.3 or zero point 0.4. So if 1.2 drops off the year over year number and you replace it with zero point 0.3, the year over year number goes down a lot. And so you're going to see, significant drops in the year over year or the annual inflation rates in the next couple of months. It's that what really matters is, are we going to get zero point 0.2 or zero point 0.3 monthly data points, or are we going to get zero point 0.4 or zero point 0.5? And, that's a big difference because if you're getting zero point 0.2 or zero point 0.3 monthly data points, then that leads you to believe the Fed is going to cut by the end of the year. But if you're getting zero point 0.4 or zero point 0.5, not only does it mean that the Fed isn't going to cut by the end of the year, they might even hike further after they pause for 2 or 3 meetings and maybe
Hmm.
take the Fed funds rate to 6%. So it's very binary right now, and it's hard to say. My sense is there's about a 70 or 75% chance that the data moderates, but there's 25 or 30% chance that inflation does start to reaccelerate based on demand for labor particularly.
Hmm.
But you can't look at oil. And I've always looked at inflation as being wages and oil. And oil's
Hmm.
down $20 in the last couple of
Yeah.
months. So if
Yeah.
inflation's going back up, it's going to be on the wage side.
Okay, we'll take a quick break.